morning, good afternoon, and good evening. Welcome to our 2021 Q1 Global ACS webcast. I'm Marie Kling, a partner in our global accounting team. And today I'm joined by two of my fellow partners from the global team, Gary Berchowitz and Paul Shepherd. Now in this webcast, we will focus on hot topics for Q1. First, we're going to take a look at interest rate benchmark reform. Then we'll switch to other hot topics, such as leases and impairments, supplier finance, in light of the Interpretations Committee recent agenda decision, and then we'll finish off with accounting considerations in transactions with special purpose acquisition companies or SPACs. Now, feel free to use the timestamps in the description below the video if you want to go straight to one of these topics that we are discussing today. But let's start with IBOR reform. Now, following the financial crisis, reforming IBOR rates has been a global priority for regulators. And as a result, many jurisdictions are well in the process of transitioning to alternative rates with the aim of moving away from individual quotes to observed trades and also increase the population on which those trades are based. Now, these changes are market-driven, and so of course there's uncertainty around the timing, the specifics of the changes. But really, given the pervasive nature of IBOR-based contracts, the reforms could affect companies in all industries. So it's really important to focus on the accounting consequences of IBOR reform. So what is the accounting for IBOR reform? Well, as we know, the ISB has undertaken a two-phase project to provide relief from an accounting perspective in order to ensure a smooth transition to the new alternative rates. Now, phase one provided temporary relief from applying specific hedge accounting requirements. Phase two, on the other hand, addresses issues that arise when an existing benchmark is replaced with the alternative reference rate. So these are the so-called replacement issues. Let's just do a quick refresh on the scope of the phase two amendments. Now, as we know, the amendments apply to changes that are required by IBOR reform. Now, there's two conditions that need to be met. First, the change is necessary, it's a direct consequence of IBOR reform, and the new basis for determining the contractual cash flows is economically equivalent to the old basis. So what does that mean? What are the implications? Let me start with cash instruments. So for cash instruments, so for example, a loan, if the two conditions I've just mentioned are met, then the phase two amendments provide a practical expedient to account for the changes. And essentially, what an entity will do is just update the effective interest rate for those changes. This is similar to the accounting we typically follow for movements in market interest rates. And what it does is it avoids the recognition of an immediate gain or loss. What about derivatives in hedge relationships? Well, for derivatives in hedge relationships, meeting the two conditions that I've just mentioned will allow hedge accounting to continue, assuming, of course, additional requirements are also met, but it doesn't lead to discontinuance in and of itself. So as entities start their transition to the new rate, the key question is, what if additional changes are made, changes in addition to the ones that are required by benchmark reform? What are the accounting consequences? So let me start with cash instruments first. So if changes are made in addition to the changes that are required, these additional changes would not be eligible for the reliefs. So an entity will first have to update the effective interest rate for the changes that are required by IBOR reform, and then apply IFRS 9 to the other changes. That is, determine whether the recognition applies, and if not, apply modification accounting. So really one has to be careful if there are other changes that are made during the negotiations with the counterparties, for example, changes to the credit spread, because only the changes that are required, i.e. that are necessary as a direct consequence of the reform and economically equivalent, are going to qualify for the relief. What about hedging instruments? Well, if changes are made in addition to those changes that would be economically equivalent, this doesn't necessarily mean that the phase two hedge accounting reliefs cannot be applied. An entity would need to look to the normal IFRS 9 or IAS 39 hedge accounting requirements to see if the additional changes result in the discontinuation of hedge accounting. If the additional changes do not result in discontinuation of hedge accounting, then the phase two hedging release will still apply, and an entity will then have to update the hedge designation and the documentation accordingly. Let's move on to disclosures. for IBOR reform. So the phase 2 amendments from a disclosure perspective require companies to make additional disclosures on the effects of the reform to help investors understand how companies are managing the effect of the transition to the new rates and the associated risks. So the key disclosures are around how the entity is managing the transition to the alternative benchmark, its progress at the reporting date, and also the risks to which it is exposed because of the transition. There's also disclosure requirements around quantitative information about instruments that have yet to transition, and finally, changes to the risk management strategy as a result of the reform to the extent there are any changes. Now, what are some of the practical questions we've received around disclosures? Well, the first area is scope of the disclosures. So the phase 2 disclosure requirements include all financial instruments that are held by the entity, and some of those may not be wholly recognized on the balance sheet, and there could be a loan commitment, for example. So the disclosure there would not necessarily reconcile to the balance sheet if that's the case. The disclosure considerations are also important in dual rate regimes. The entity may need to further tailor the disclosure requirements to reflect the different transition expectations, for example, different classes or tenors of financial instruments. The second area is just the nature of the quantitative information. Phase 2 disclosure requirements, again, give flexibility as to what numerical basis is used to disclose the items that have yet to transition to the new benchmark rate. So preparers can use balance sheet carrying amounts, or they can instead disclose quantitative information just on the basis of the information that is reported internally. For example, the information that's reported to key management personnel as part of the implementation of the benchmark reform. Key thing to remember is that the basis on which the information is provided actually needs to be clearly stated. And the last thing to remember on disclosures is that the quantitative information needs to be disaggregated by significant interest rate benchmark, subject to the reform, and then shown separately for non-derivative financial assets, non-derivative financial liabilities, and derivatives. So, where to go next? So if you have additional questions around IBOR reform, we've published a practical guide to the phase 2 amendments. We're updating it regularly for all the new questions we're getting based on the transition activity we're seeing in the marketplace. So there's a series of frequently asked questions that help navigate some of these complex requirements.
Hi, I'm Paul Shepherd, and welcome into my home in Sydney. Today, I'm going to cover the interaction between the leasing standard and the impairment standard. As a result of the adoption of IFRS 16, we have right-of-use assets and lease liabilities recognised for leases that were not on balance sheet in the past. If there was a problem with a lease in the past, it's likely consideration was given to whether it was an onerous contract or not. That's no longer the case. With the change in accounting, leases will now be considered as part of the impairment testing. While many of our clients had finance leases recognised and have had to perform impairment tests on those in the past, this new focus on leases has identified questions in the detail that we may not have focused on in the past. I will take you through a few key considerations for impairment of right-of-use assets. These are: at what level do you test, when do you test, and how do you test? At what level do you test? Impairment should be assessed at the individual asset level if the asset generates cash inflows that are largely independent from those of other assets. To be honest, it is unlikely that a single leased asset will generate independent cash flows, which means the asset will need to be tested as part of a larger cash generating unit. This does not necessarily mean that it is tested at the same level as goodwill. For example, many companies that have large lease portfolios would be in industries where they have a lot of direct interaction with customers, like retail and entertainment. It is likely that the CGU for these right-of-use assets will be at the individual store level. When do you test? The general requirement of IAS 36 is that assets are tested for impairment when there is an impairment indicator, and this includes right-of-use assets. Where the right-of-use asset is part of a CGU that contains goodwill, indefinite life intangible assets, or intangible and other assets that are not yet ready for use, it will be included as part of the annual impairment requirement. Where we have seen the greatest impact lately is in retail, where each store is a CGU, and COVID has meant that stores are closed or operating at a significantly reduced capacity, resulting in more testing of individual stores that may not have been required in the past. How do you test? Recoverable amount. IAS 36 compares the carrying value of the asset or the CGU against the hire of the value in use and the fair value less cost of disposal for the CGU. While the right of use assets are included in a CGU when testing value in use, the related lease liabilities should be excluded because these are a form of financing and all financing cash flows are explicitly excluded from a value in use test. It is likely for a fair value test that the lease liability would be included in the net assets of the CGU. This is because when the CGU is disposed of, the buyer would assume the lease liability. In this case, in order to prepare a meaningful comparison, the carrying amount of the liability would be deducted from the net assets of the CGU. When it is possible that there might be an impairment and both a value in use and a fair value calculation have been performed, it's necessary to compare like with like. So to do this comparison, the IFRS considered how to treat the liability, and they confirmed that for the value in use calculation, the carrying amount of the lease liability, not the cash flows, should be deducted from the value in use and also the net assets of the CGU. This has no impact on the value in use test, but it means that the value in use can be compared with a fair value less cost of disposal. Leases typically have a term, and as such, it is necessary to consider the impact on the impairment test. For some lower level CGUs, for example, a single retail store, it may not be appropriate to perform an impairment test using cash flows into perpetuity because the lease term limits the life of the asset and the CGU being tested. When testing larger CGUs, for example, that include right of use assets and intangible or other assets with lives longer than the right of use asset, it is necessary to consider how to deal with the replacement of the right of use asset in the future. There are a few different ways your client might approach this. Look at the guidance that has just been added to the online version of the Manual of Accounting for help on these topics. We also need to remember that the right of use asset and the lease liability does not incorporate variable rent and short-term leases. So these cash flows do need to be incorporated into the impairment test. So in summary, we now have to test right of use assets for impairment, and this will differ to accounting for onerous leases. Impairment testing will now happen at a lower level and in some industries where there are large portfolios of property leases. And be careful with how you treat lease liabilities, lease cash flows, and lease renewals in impairment tests.
In recent years, we've seen an increase in the use of supplier financing or reverse factoring arrangements. And supplier financing arrangements have made the headlines recently too. Now, in December of 2020, the IFRS Interpretations Committee issued an agenda decision on supplier financing arrangements. Supplier financing is often referred to as reverse factoring or several other fancy names. Now, but it generally involves three parties: a supplier who supplies the goods, the buyer, and a financier, which is often a bank. The bank offers to facilitate payments of the trade payables arising between the buyer and the supplier and may provide finance so the supplier can be paid earlier or the buyer can pay later than the due date of the original trade payable. The agenda decision released by the IFRS IC may affect some or all of the following: your reported working capital, ratios used in borrowing covenants, net debt disclosures, cash flow statements, and targets for management performance. The following specific areas were addressed by the agenda decision: the derecognition of the financial liability, presentation in the statement of financial position, presentation in the statement of cash flows, and disclosure under IS 1 and IS 7. Let's first look at the potential derecognition of the trade payable. Now, for the buyer, which is the reporting entity we're looking at here, the key issue is whether it should derecognize its original trade payable to the supplier and recognize a new liability to the bank. And this is important because if the trade payable is derecognized, the buyer would recognize a new financial liability, initially measured at fair value, and they would recognize a gain or loss based on the difference between the carrying amount of the original trade payable compared to the fair value of the new financial liability. The buyer would apply IFRS 9's derecognition requirements when assessing whether and when to recognize the trade payable. And the trade payable is derecognized if either the trade payable is extinguished or its terms are substantially modified. Now, folks will probably realize that the committee didn't really provide any further guidance than considering IFRS 9, so our existing application guidance on this is largely unchanged, is maybe the good news. The second point that I mentioned was presentation in the statements of financial position. And if the buyer concludes that the trade payable to the supplier is derecognized and recognizes a new financial liability to the bank, it will apply IS1 in determining how to present the new financial liability in its statement of financial position. But even if the buyer does not recognize a new financial liability in place of the original trade payable, I think the buyer still needs to consider the presentation of the liability subject to the reverse factoring. And the principle reinforced by the committee was that an entity should consider the characteristics of the liability based on the reverse financing terms by applying IS1. And in applying IS1, the committee noted that an entity presents liabilities that are part of a reverse factoring arrangement as part of trade and other payables only when those liabilities have a similar nature and function to trade payables. For example, when those liabilities are part of the working capital used in an entity's normal operating cycle. The other important point was that the committee clarified that an entity should present the reverse factoring liabilities separately from trade and other payables when the size, nature, or function and timing of those liabilities makes separate presentation relevant to an understanding of the entity's financial performance. I think that's a really important point. Now, the committee didn't go so far as to say that if you recognize a new liability as a result of the factoring, then it must be recognized as a loan or some other financial liability outside of trade and other payables. However, the committee observed that an entity assessing whether to present liabilities that are part of a reverse factoring arrangement separately might consider certain factors, and they gave a couple of examples. The first was whether additional security is provided as part of the arrangement that would not be provided without the arrangement. And the second was the extent to which the terms of the liabilities that are part of the arrangement differ from the terms of the entity's, what I'll call normal trade payables that are not part of the arrangement. And I think we at least continue to think that if the terms of the arrangement are changed such that a new liability is actually recognized, that is a very strong indication that the nature and function of the liability is sufficiently different to warrant presentation as something other than your normal trade and other payables. I think the key point here is that judgment will likely be required as it was in the past, and I think clear and transparent presentation and disclosures will be key. Let's move on to presentation of the statement of cash flows. Now here the committee said that a buyer would need to consider how to present the cash flows from supplier financing arrangements, and consideration has to be given to whether to present the cash outflow from operating activities and a cash inflow from financing activities when the financier settles with the supplier. Now, if a cash inflow and outflow occur for an entity when an invoice is factored as part of a reverse factoring arrangement, the entity will present those cash flows in its statements of cash flows. However, if no cash inflow and outflow occurs for an entity in a financing transaction, the entity discloses the transaction elsewhere in the financial statements in a way that provides all the relevant information about the financing activity. And I think here it's important to realize that even if someone has concluded that the transaction is a transaction that doesn't give rise to cash flows and is not recorded in the cash flow statements, you may still be required to provide the disclosure related to non-cash transactions in IS7. And speaking of disclosure, I guess let's move on to then the last aspect that the committee looked at, which was disclosure. And the committee here pointed out several areas of IFRS that might be applicable to supply chain financing or reverse factoring. For example, IS7 requires an entity to provide disclosures that enable users of financial statements to evaluate changes in liabilities arising from financing activities, including both changes arising from cash flows and non-cash changes. Now, such disclosure is required for liabilities that are part of reverse factoring if the cash flows for those liabilities were, or future cash flows will be, classified as cash flows from financing activities. And that is often the case. To the extent that significant judgments were made in terms of the derecognition or presentation in the income statement or the cash flow statement or the balance sheet, these should be disclosures that are made in accordance with IS 1 paragraph 122. There's quite a lot that the committee obviously said, but not a huge amount that I think would necessarily be different to a lot of the way we've looked at these in the past. So I at least take away the key overall message here is that to the extent that an entity has material supplier financing arrangements, disclosures thereof should be clear and sufficient to enable users to understand the impact of the supply chain financing on the entity's financial performance and its position. Now, please look out for our revised in-depth on supply chain financing, which will be coming out soon. It'll cover each of these aspects in a bit more detail and hopefully provide some useful insights. So, special purpose acquisition companies, or SPACs, have become the preferred way for many entities to take companies public. Now, SPACs completed nearly $26 billion of share sales in January of this year, according to data compiled by Bloomberg. So clearly this is a very topical commercial transaction at the moment. Now, a SPAC is created with capital from initial investors, and it undergoes an IPO to raise additional capital with the intention of acquiring one or more unspecified operating companies. So on the date that it does its IPO, it's really just a shell generally sitting with a big bunch of cash. Now, after being acquired, the OpCo effectively becomes a public company or a subsidiary of the public SPAC without executing its own IPO, which some may find actually quite favorable. Now, accounting and reporting for such transactions is complex, both in terms of the accounting, but also in many cases the regulatory requirements. Now, when accounting for a SPAC transaction, there are many accounting challenges, and I'll discuss the most common accounting challenges over the next few minutes. So the first is, which entity is the acquirer? Now, as we know, the accounting acquirer is the entity that obtains control of the other entity, in other words, the acquiree, and they may be different from the legal acquirer. Now, the SPAC is the legal acquirer, and the operating company or OpCo is the legal acquiree. However, in substance, the transaction might be the other way around. If the SPAC issues equity or a combination of cash and equity to legally acquire the OpCo. And if this is the case, the arrangement is typically accounted for as a reverse merger. And this is equivalent to the issuance of shares by the OpCo for the net assets of the SPAC. And a review of the specific facts and circumstances is normally required to be able to conclude on that. But as I said, typically in most arrangements, it is some form of reverse merger. And you'll notice I said merger rather than acquisition, because the second question is this a business combination? And this determination often depends on which entity is identified as the accounting acquirer. Now, if the SPAC is determined to be the accounting acquirer, then purchase accounting will apply, and the target company's assets and liabilities will require a valuation to be stepped up to fair value in accordance with IFRS 3. So no problems there. But if the SPAC is the accounting acquiree and the OpCo is the accounting acquirer, the transaction might not be a business combination, because the SPAC generally would not meet the definition of a business if it's really just a shell sitting on a lot of cash. And in many cases, if that's the case, IFRS 2 rather than IFRS 3 will be the applicable guidance for accounting in relation to the SPAC merger if the arrangement is not a business combination. Now, what's important there is any difference between the fair value of the shares deemed to have been issued by the OpCo and the fair value of the SPAC or the public shell company's identifiable net assets actually represents a service received by the OpCo, and that is a listing service. Now, no portion of the listing service as a result of the share-based payment is considered to be a cost of raising capital. In other words, it can't be deferred in equity. The service received does not meet the definition of an asset, and the cost of the service received is therefore recognized as an expense. And this was confirmed by the IFRS Interpretations Committee a couple of years ago. The next question that is quite topical is how would the associated transaction costs be accounted for? Now, transaction costs are recognized in equity, as we know, only if they're incremental and directly attributable to the issuance of equity. And in a SPAC arrangement, it might be challenging to determine what costs, if any, relate to the issuance of new equity in exchange for funding if the legal acquisition is accounted for as a reverse merger. The next question, which we see quite often, is how would contingent share issuances be accounted for? And this is important because often the SPAC or the OpCo will enter into arrangements with shareholders, sponsors, or employees to issue additional shares post the transaction, post the merger, if certain performance measures are met. Now, determining whether IFRS 3 or IFRS 2 or possibly even IAS 32 applies to these contingent share purchases will depend on the substance of the arrangement. Why were those contingent share issuances entered into, as well as an assessment of the accounting acquirer in the SPAC merger, which I mentioned before. The accounting to a large extent will depend on many factors with respect to contingent share issuances, including who receives the contingent payments. It might be the shareholders of the target company, the shareholders of the SPAC, or the sponsors of the SPAC, or employees and other service providers. And what is the economic substance of such payments as part of this assessment, gaining an understanding of the commercial driver for the contingent share issuance. Another factor is, are the grant of equity instruments conditional upon satisfying specified vesting conditions? So a lot of things to think about. Then we move on to taxes. No analysis would be complete if we didn't think about taxes. And the tax implications for one of these transactions would be impacted by the determination of whether the arrangement is a business combination and of the entity that is identified as the acquirer. The tax implications would also be impacted by the way in which the relevant tax authority considers the arrangement. So again, a lot dependent on the facts and circumstances and understanding the transaction and the way it's treated by the tax authority. And last but not least, what about some presentation challenges? Now, when the transaction occurs, the SPAC will typically issue shares in exchange for the shares in the OpCo. And where the OpCo is identified as the accounting acquirer, complexities can arise in relation to the comparative information and the merger equity structure and how this is presented. Now, the merged entity might also need to consider adjustments to calculate earnings per share if the arrangement is deemed to be a reverse merger. So we've highlighted some of the typical accounting complexities that need to be considered for SPAC arrangements. However, there are usually additional capital markets regulatory requirements that need to be taken into account as well, including assessing various financial reporting and filing requirements. There might also be pro forma reporting requirements that need to be considered, and these regulatory requirements can be just as complex and burdensome as the accounting requirements. Although I guess sometimes what a preparer might consider to be burdensome might be considered as really interesting from a technical accountant's perspective. Now, we again plan to issue an in-depth in the near future, which will consider the financial reporting and accounting considerations mentioned here in more detail. So please watch this space if you are lucky enough to get one of these complex accounting transactions come past.
Okay, we hope you found this webcast today helpful. A key issue that we didn't discuss that's also very topical is climate risk. And we actually have a separate webcast on climate risk that's coming out soon. That webcast will primarily focus on the financial reporting implications of climate change and how climate change impacts the numbers and the disclosure in the financial statements. So watch out for that separate webcast.